All right, welcome back, traders. John Caruso here. It's a new month, August 1st. Taking a quick look in on the markets. The S&P's kind of dancing around Friday's highs at 4130. We did see the PCE index actually climb on Friday. That's, of course, the Fed's main inflation gauge, to up 4.8% on a year-over-year basis. I believe the market was looking for 4.7, which was also the previous reading. So clearly, we still haven't solved the inflation problem. Of course, we're going to get the CPI numbers out, I believe, August 10th. I'll have to double check that. But still, the inflation backdrop still remains sticky, elevated. I think that's going to be a problem. Obviously, the narrative right now is kind of shifted to Powell's, semi-dovish pivot. I didn't think it was all that dovish, but of course the market took it as an olive branch and it is running with it right now. So I do acknowledge that we could still see some more upside in the equity markets over the course of the next, we'll say 3 to 6 weeks. You're going to see some heavy resistance, we think, come in around 4,250 to 4,300 in the S&P. And if we were to get up in that level, I think that's going to be probably a very obvious place to start looking at becoming bearish on stocks again. So we're going to keep that in mind. So I'm also hearing the narrative that this is very similar to 1982. If you recall, back in 1982, we were coming out of back-to-back recessions here in the United States. Paul Volcker jacked interest rates up to combat inflation. We came out of a decade worth of inflation of the 1970s, of course. And we heard the Ronald Reagan, "It's Morning in America" speech. So I do not think it's 1982. Of course, 1982 from there would set off a 5-6 year bull market, of course, leading us into 1987. I don't think that that's the case right now. We still have yet to see the recession. The recession is coming. From a technical standpoint, obviously negative GDP for 2 consecutive quarters. From the technical definition, you could suggest that it's that we are in a recession right now, but we haven't seen that start to bleed into the labor market. The labor market is still very strong. However, it is starting to show some signs of cracks. We just saw last week's jobless claims tick to an 8-month high. So you want to be very, very careful going forward in this market. I don't believe risk on is going to be the theme through September and October in this market. So be very mindful of that. Yield curve inverted 26 basis points. That's a heavy inversion of the yield curve. So right now you've got a lot of economists out there trying to move the goalposts in terms of what used to be economic harbingers in the past. They're suggesting that the yield curve doesn't matter anymore. Back-to-back quarters of GDP doesn't matter anymore. Well, we say that they do. And that will start to work its way through the market, we think, as we come out of August into September and October. So be mindful of that. Gold prices seeing a very strong rally. December gold, $1,789. I do think we've got a chance of getting up above 1,800. But gold is starting to give us some near-term overbought signals. We still love gold longer term. But I think it's time to start maybe paring back some of those positions. Still keeping a long presence, we think, for the balance of the rest of the year. But starting to put a little money in your pocket on that trade, I don't think is a bad idea. So that's all I have for you here today. We're going to catch you back here throughout the rest of the week. I'm John Caruso. Have a good one.